Welcome back, folks. You're still watching Smart Money on CNBC-TV18. I have with me Kirtan Shah, founder and CEO of Credence Wealth Advisors. And today we're discussing what you should not be doing in your investment journey. So all the products that you need to avoid. Let's now discuss about the importance of asset allocation strategy in your investment journey. Now, you always need to have the right asset allocation and plan. And one thing that you should avoid is you should never keep all your eggs in one basket. Do not have 100% in either equities or 100% in fixed income. Now, 100% fixed income portfolios have never been able to beat inflation post-tax. So it's pretty much like taking your money, just digging a hole in the ground and putting it there. It's never going to grow. Kirtan, come in on this. You know, the right asset allocation strategy is so important, especially at a time like this when equities have taken a backseat, gold has done very well. So what is your recommendation here?
I think, Sonia, what's important to understand as a retail investor that the reason why most retail investors are not able to do proper wealth management or they are not able to experience the wealth creation journey is because apart from everything else, the bigger problem is the behavior, right? Because you've not been an investor for a long time. You've not seen a lot of ups and downs and volatility in various asset classes. And hence you tend to kind of take steps which are not very prudent from your investment standpoint. That is exactly where I think asset allocation plays a very important role, because all it will do is, depending on your risk appetite, if you've got your asset allocation correct, it'll keep your behavior in check and help you make or help you stop making random unnecessary decisions. Because typically what happens is, even when you are, let's say, a very aggressive investor, right, and you are okay with the volatility of the markets, but if you keep 100% of your investments in equity, time and again we've seen with investors that when markets fall and they know that markets are going to recover at some point in time and they want to allocate more money, they would typically not have more cash. That's exactly where asset allocation comes into picture, that even when, as an aggressive investor, had you had 20% in fixed income, you would have been able to buy equity markets at a lower level. And like you rightly pointed out, I think 100% in fixed income has never been able to beat inflation post-tax, right? I understand that if you are conservative, you would want to put 100% in an asset which is less volatile. But even if you do a 70-80% fixed income and a 20% equity with some element of gold, and if you have a 3-year of investment horizon, your portfolio is not going to see a lot of volatility, right? So even though you are conservative, a 20% allocation to equity or gold will not really push you to change your behavior, because your portfolio is not going to move aggressively. So I think if the retail investor really wants to be able to maintain discipline and create wealth over a period of time, I think what has to be kept in check is their behavior, which actually asset allocation, if done the right way, will help them.
Okay, all right. Now, there's one more thing that you should avoid, right? Investing in instruments that you don't understand. So that's what I'm going to talk about next. Retail investors should try and avoid all products that they don't understand. And there are several such products, whether it's small cases, whether it's PMSs, AIFs. Now, in a PMS, you end up investing a large chunk of money in one fund. So a PMS has a minimum ticket size of 25 lakhs. So you invest in one fund with one fund manager and one style of investing. It's always better to spread your investments across market caps and different styles of investing. So perhaps that's a reason maybe you want to avoid PMSs. But Kirtan, you tell me, what are the instruments that a retail investor should perhaps avoid? Maybe because they just simply don't understand how they function.
Sonia, I think very honestly, in my opinion, there is nothing better than mutual funds that probably you should look at as a retail investor, because at the end of the day, if you want to do equity, you want to do fixed income, you want to do gold, you want to do international investing, you have everything made available because mutual funds allow you to invest in all of these asset classes. The problem is when a lot of retail investors get carried away with products like AIFs that they don't understand absolutely, right? There is hardly any data available. The ticket size is so large, right, of 1 crore, that you end up taking concentration risk by investing almost all the money that you've accumulated so far in one asset class and probably with one fund manager. Even if you talk about small cases, there is so much of lack of data or lack of historical performance data points that you really have as available. And because there is so many of these products are not so highly regulated like mutual fund is, you don't even know if things go wrong, how do you actually end up making sure that your portfolio is not hampered? And like you rightly said that, if I have 50 lakh rupees to invest as a retail investor, hypothetically, right, instead of doing 50 lakhs in a PMS, which is the minimum ticket size, I might as well do 10 lakh rupees into five mutual funds, where I'll be able to, work with 5 different fund managers, 2, 3 different investment strategies. I can diversify my fund across large cap, mid cap, small cap. I'll be able to do so much by investing the same 50 lakh rupees in a mutual fund versus giving that 50 lakh rupees to one fund manager and taking that concentration risk. So definitely, I think the simpler you keep your investments, the longer you will be able to sustain, because it'll not give you unnecessary pullbacks, which otherwise you would receive if you've not understood the product that you are investing.
Okay, fair enough. So concentration risk is something that you should avoid, right? So better to not park your money, a large chunk of money, in either a PMS or an AIF. But let's now also discuss about fixed income investments. Now, fixed income investments is not for generating high returns. So remember that fixed income is for capital protection and it's not for generating high returns. The common mistake that investors generally make is to take a credit risk. So avoid taking large bets in one bond or one particular fixed income product. Fixed income is still, Kirtan, a space that a lot of people can't navigate easily. Tell us a little bit about that. What are the do's and don'ts here?
Sonia, I think this is a very important discussion on this talk of ours, is because because while we interact with clients, we see that everybody is looking at generating higher returns, right? And even when you are wanting to generate higher returns on the equity side, it is understood because the asset class is meant for growth. But there are so many of these investors who want to, kind of experience extremely high returns even while they are doing fixed income investing. Now, fixed income investing has a couple of problems, right? First, you have to understand that when you try and look for higher returns, you invariably, if you understand or don't understand, that is secondary, you invariably end up taking higher risk. So if there is a product which is paying you 8% versus a product which is paying you 12% fixed, it's a no-brainer that the 12% product is taking higher risk, right? The problem is that most of us don't understand what are the various risks in fixed income, and should we or should we not invest in that 12% because it is paying a slightly higher return, but whether we'll be comfortable with taking that risk. Now, the problem here is that in equity, while you invest, you know for a fact that you are taking a risk, right? And you know that the 100 rupee of capital that you've invested can go down to 90. But there is a probability that 100 can become 120. The problem with fixed income is that most investors don't really understand that the risk can lead to a complete capital and interest wipeout, right? Unlike equity, where you lose capital, there is a probability that you can get the price back. In fixed income, 9 out of 10 times what happens is, if you got your bet wrong, right, and if the company defaults, you lose your entire capital along with interest. So in fixed income, while you're trying to invest, I think at least the way I look at it is look at fixed income from a capital protection standpoint. Of course, if you understand how to invest in fixed income, you can definitely generate some alpha, but do not try and maximize your returns in fixed income, because invariably, whenever you will try and pick a fixed income product which pays you higher returns, there is definitely going to be higher risk, which you may not understand.
Okay, that was a very helpful, analysis and some helpful tips on what one should be avoiding in their investment journey. With that, it's a wrap. Kirtan, thanks a lot for joining in. We've run out of time, not out of questions, of course. But in case you have any feedback on the investment advice, the investment tips that we give out, and anything that you want us to cover on the show, please write into us and keep watching CNBC TV 18. Have a great weekend.